quick fact check, by the way. So it was geography, not geology. I messed that up, but Jordan did go back and get his degree.
I mean, sure he did.
What is that? That's the most unnecessary doubt of all time.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
What's going on? How's your week?
My heater broke, and I'm just going to have to brave it in the 39-degree weather today.
I feel like you have heater drama every week. Was it last week?
All the time.
Man.
What's happening?
Okay. There were 100% less attacks on the Capitol this week, so that's positive.
Yeah.
What's in your brain? Any updates or anything? You want to hop into the fishbowl?
I want to start by talking Bitcoin. Okay, so there's 18.5 million tokens, right? According to an article in the New York Times this week, it's estimated that 20% of that supply has been lost, basically due to lost passwords, right? So they're saying $140 billion of current valuation is gone. Give me some thoughts on this, Doogles.
I have two trains of thought. I think one is I can see where this supports the Bitcoin hypothesis. And in another, it makes me say, like, this is why we have banks. Right, I can go down both of those routes. With the first being, you mentioned the amount of Bitcoin. Part of the whole Bitcoin thing is that there's limited supply, right? Will never be created more. So if it's lost, it's lost, right? And the fact that it's decentralized, like unregulated, not maintained by anybody, is like that's the whole thing, right? And the fact that no one can get into it, it's not like you can call up, Fannie Mae and be like, can you get me some of that Bitcoin? I don't know why Fannie Mae. I'm not sure why that came, but you can't.
Bank of America.
Yeah, you can't call anybody and get it. I get that.
Like, you're exactly right. That is the whole thing: the decentralized, non-managed, no central government. The best hypothesis I've heard. Let me go on the record and say I don't think Bitcoin is an investment in any way, shape, or form. I think it's a speculation, and I'm fine if you want to do that speculation. You can convince me that it might work out, but it's so interesting that you have, if 20% of the supply evaporates over basically a decade. I mean, I think Bitcoin came out in 2008, 2009 or something like that, formally. That means that the demand has certainly grown and the supply is certainly shrinking, right? And it's easy to make the argument that the demand will continue to grow because in places like China, where you don't necessarily want the government to have hands in your finances, and they could if they wanted to, or speaking of the real Jack Ma, we need to follow up from last episode on that, or Venezuela or wherever else. So one of the crazy things about that article is they were saying there's intermediaries that are trying to like act as a bank now to stop people from losing their passwords. But that's hilarious because that kind of moves away from the central thesis.
The whole point.
Yeah. So then on top of this, if we move quickly through this, because this is not a Bitcoin podcast, like then Jack Dorsey, when he talks about suspending Trump's account, in his fifth tweet in that tweet storm, goes to a decentralized social media structure built on the back of blockchain, which I just think is super interesting. And we probably, I don't know how much of a debate we can do today, but the fact that he is trying to use that as a way to say, I want to move away from human-based censorship to a decentralized system, I just thought was a really interesting thing. I couldn't tell if he was plugging that technology. He's obviously a huge Bitcoin guy. He's a huge decentralized guy. Or if he was skirting blame with the decision that Twitter made. But I just thought, wow, that's an interesting tie-in that I didn't see coming.
Have you seen his beard?
Oh, have I ever?
I'm not going to say it causes some credibility loss, but
he doesn't care. Doogles, he doesn't care what you think about his beard, just so you know.
Oh, I mean, obviously. I think he's a fascinating character.
I mean, my favorite Jack Dorsey fact is he hasn't used a computer in like 10 years or something. He's the CEO of 2 highly successful companies on just an iPhone.
Yeah, I was gonna say, when you say he hasn't used a computer, you mean like he uses a computer, but it's very small.
Still, like he's doing everything like via tweet, basically. I mean, he's shooting some emails and some Slack back and forth, and that's it. Now maybe he just has minions to do it, but he's also doing yoga in Myanmar like a month a year, and he was moving to Africa until they were trying to kick him out of the CEO border. That was the rumor.
What else is in the fishbowl?
I want to talk about Howard Marks. For those who don't know, Howard Marks, brilliant. I call him a value investor, founder of Oaktree Capital. Great guy. He had an 18-page article, which I thought was a little long-winded. How about you, Doogles?
I think it's about 2x what it needed to be, most likely to get the point across. It could have been a tweet, to be honest.
The craziest thing is I kept trying to find the 1.7x on my reading, and it just didn't work. It was like...
So what would you glean from this wondrous piece, this memo?
He's talking about what everyone else is talking about right now. Value investing is underperformance. If you just look at simple, like factor-based definitions of value investing. So he starts by defining it in a different way, a more broad way, saying it's really not about something that's cheap. It's about something that's discounted from its intrinsic value, which I completely agree with. But there's a sentence that just threw me for a loop, and Howard Marks is incredibly smart. So he worded it in a way where it's never going to be like a gotcha sentence, but he said, my background had me biased toward mean reversion. What he's talking about there is basically buying things that are undervalued and waiting for them to revert to the mean to make your money, the traditional value investing style. And he says, and thus caused me to not fully grasp the potential of fade-defying business models.
Yeah, so I think that line, I think, has brilliance in it, but not for the reason he used it. Like the brilliance that I see is in thinking about this from a business context. I think it's fascinating to think that there are certain business models that can get a flywheel going. We've talked about the concept of a flywheel going, and that flywheel can go like beyond what one might imagine, right? Amazon, I think, which we talked about last pod, I think is a fantastic example, right? If you go back the 22, 23 years, it's when Amazon went public. I mean, it was crazy. Amazon started going crazy during the dot-com bubble and got to a point where you could not justify its valuation based on anything that was rational happening in the future. And Amazon crushed all that rationality. After it dropped 90% at one point, but then came back to that level, which is different than something like a Cisco, for example, at the time, which hit like a crazy valuation, et cetera, and still has not gotten back to that point today. But because Amazon had this flywheel that of innovation, really, that Bezos continued to turn with he and his team, right? That I think could create something great. And so there are these businesses that can do that. At the same time, go ahead.
Go.
At the same time, I think for the average investor, believing that will make you throw more of your grandma's money in Tesla, which is dangerous.
Yeah, you nailed it. I mean, I'm sure the debate in the early 2000s about Amazon's valuation was like, hey, listen, that valuation only makes sense if Amazon is soon bigger than Walmart, and then everybody laughed, right? Well, what Amazon did is became bigger and better than Walmart. Like that's a 1 in a million thing is my point. And so as a general strategy for investing, I do think it's incredibly scary. And it's interesting to hear someone who I respect so much kind of throw that idea out there. But listen, this is what happens when a certain investing style underperforms for a decade. Like, I mean, everyone that's been hardcore value their entire career is going, oh, gosh, I need to find some way to at least justify this to my investors because they're pissed. They're watching all their friends make money in Tesla and Amazon and whatever else. And my strategies aren't performing. So some of that I feel like is self-serving potentially. I'm not talking about Howard specifically in this case, but a lot of people, when their strategy isn't performing as they would wish, they're looking for ways to explain that.
That takes me back to a conversation that we had about my boy, our Shills, that you brought up, I don't know, sometime in the conversation we're having recently.
It's Robert Shiller, folks, Robert Shiller.
Robert Shiller, Yale professor, came up with something called CAPE, cyclically adjusted price to earnings ratio.
Exactly.
And so it takes your typical PE ratio, stock price divided by earnings, right? But then adds in this the 10-year rolling right, aspect of it. So you look at 10-year rolling PE ratio and look at how that does or does not correlate to the market, right? And you were saying that he's been riding that wave for 40 years, 40 plus years at this point on Cape, and then recently came out and said, okay, Cape said that the market has been overvalued for 5 years. Market's gone up during that period. So let's adjust and throw some interest rate into it as well. And now say when interest rates are low, that justifies how Cape can be showing something that the market doesn't reflect.
Yeah, you're exactly. This is a brilliant point because for 40 years he's said, it's good enough. You know, there's been all sorts of criticism because really for the last decade or so, even more, we've been saying U.S. stocks are essentially overvalued and they keep going up. And so I like what he did with his revision to the model, but it's interesting, right? He almost had to do something. And this is not throwing Robert Schiller, your boy, under the bus. It makes sense, but it's just kind of how human nature works too. If his model was still had the same predictive power, he wouldn't have done an update to it in 2021, right? He would have rolled with what was working.
I think it's interesting when you look at what the human behavior signs of euphoria or bubble are. So there's consensus, right? And people that for decades have believed something are now questioning whether the questioning is valid or not, but questioning. I have a bubble. It's something I've been playing with. Maybe I call it a froth indicator. So what I've been playing with is this. You know how the core basis of my model, like not the philosophy behind it, but the only thing I look at are returns, and then how those returns of a given stock look compared to the returns of the market, and that ratio, right? So returns relative to the market. And with any given stock, you can look at its returns over the last 5 years and how that fares to the market. If you take the median of every stock that's in the market and say, what is the median relative rate of return to the market?
The central point of stock performance.
Yeah, exactly.
Yeah.
Is what I found is that once that gets to somewhere that's like below the 60% mark, like starts to indicate something. And it doesn't mean that something won't pop before that occurs, but it's really interesting.
I love this, and I didn't mean to interrupt. So, but okay, there's a lot of interesting going on here. One thing that's important to notice, because I was in a debate this week about valuations relative to the market, or valuations. Like I'm going to argue over the next several weeks that value stocks are the appropriate strategy going forward in 2021 and beyond. But the questions that came as I debated that this week was, well, yeah, that's like the valuation spread between growth and value right now is very, very high at one of its greatest points ever. But if growth is so much overvalued, like, does that actually mean value is cheap or undervalued? Or is that just another metric saying growth is crazy? What does that really tell you?
So at the start of this year, the Doogles indicator, what it's showing us is that we're at like a little under 0.7, so 0.68, which is closer to where things sat at like the start of 99. Now, that does not mean that we're in 99. Everything's different, right? The macro environment's different. We're not in the same bubble, but it is interesting because it shows that there's a concentrated piece of like value of bubble, right? That's happening in the market, and it's leaving a lot of the market behind. Like we are in territory where it starts to become interesting to look elsewhere.
Yeah, let's talk about that next week, because I want to better digest exactly what that's saying, and maybe we should build some visuals around it, because really you're talking about if the median stock is over or undervalued relative to the average performance. Is that what you're saying? Yeah. And so that is it's an interesting thing to think through. You sent me an analysis this week breaking down basically top performing stocks relative to the market of all time. I thought there were some good names on that list. You want to hit some?
Yeah, I thought that was pretty interesting. Let me pull it up.
Are these three the top five, Doogles? Off the top of my head, I had Monsters Beverage, Amazon, and Altria Group.
That's what you believe we're top
MO.
three?
Oh, yeah. I mean, I'm pretty sure I nailed it.
No, I'm pretty sure you didn't. So
well, bring some facts to the conversation.
Yeah. So what I looked at is if you look in the history of all stocks, right, that have ever existed, and look at their performance relative to the market, what comes out on top And this includes stocks that no longer trade, right? So something could have performed incredibly well, crushed the market, and then got acquired, right? For example, and it would still be on the list. So number one's Amazon. Number two is Altria Group, and number three is Home Depot.
No, but Monster Beverage is in there somewhere.
Well, I mean, every stock is in here somewhere. So Monster is it's a top three over the last 20 years, but it's not a top three all time. Yeah, last 20 years is something like Netflix, Monster. But what I think is most interesting here is Altria Group, and the reason why is because if you go back to 2003, which is the last time I produced this list.
Nice.
So 2003, Altria Group was number one by a long shot. Like no stock could even come close to how badly beaten the market. And Altria Group has effectively gotten beaten over the last 20 years, like for the most part. It hasn't. It's had ups and downs, but it's gotten beaten relative to some things like Amazon, and it's still number two. Like that just shows you how dominant it was, creating a highly addictive product, acquiring other companies that are also highly addictive, like mac and cheese, which I might gobble later because now I'm just getting hungry. And it's crazy, right? It just shows you its dominance over decades and decades.
No, you know what's also brilliant about that is I've held Altria Group many times within the past 15 years, 2 or 3. So let me not say many, because it's been a value stock. Like it's been dirt cheap. And the rest of the names on that list, actually Home Depot early in the pandemic had a time where it looked like it was relatively cheap. So that's interesting. But a lot of the names on that list, you think of as high flyers, fate-defying business models potentially, right? But no, you can get some of the best performing stocks of all time at crazy deals, and I have. But then, yeah, Altria the last like 20 years is such an interesting story because the stock still performs despite all the headwinds that come with business regulation and taxes and everything else.
Got a hot dividend too.
Yeah, it does. Is it still like 6% or something?
I think it's something like that. By the way, Monster is number 174 on the list at about 12.88 the market. So number 174. That's kind of I feel like this is
on
this
probation.
Exactly. It reflects how you look at your own portfolio too. And you're like, oh yeah, my portfolio is crushing it. It's hot. Value's it. And I'm like, no, you're like, I think you hit some rows. Yeah, you hit some rows when you were looking at how you fare relative to the average investor. So
oh man. All right. So I know you're gonna grab a few things out of the fishbowl. We just need to follow up. This is all speculation, but sometimes speculation is fun. Last week we did like 5-10 minutes on Jack Ma, right? And Ant Group and everything else. And how I remember it, and I'm not so good with my memory, but I remember me saying China's going to crush him and take over his businesses. And then this week, what happened, Doogles?
Nationalization.
Yeah, isn't that crazy though? So what does this mean? Is he locked up? Is he just told to go away somewhere? What are they like? Are they going to pay him out what his businesses are truly worth? Are they going to discount it, or do we know none of the answers to these questions?
We know nothing. The only thing that we know, or that it seems like is going to happen, are people that are in the know seemingly are saying that the Chinese government is going to take over Alibaba. So that's the whole nationalization thing. It continues to be crazy. The more that this type of news comes out, and no one says it, like no one that is Jack Ma, or no one that is pretending to be Jack Ma, or no one that knows Jack Ma mentions anything about Jack Ma. Like that is insane, isn't it? I mean, can you imagine?
Yeah. Where's Jack Ma's mom or like
Miss
girlfriend
Ma.
or
Hey,
something?
Ma.
I mean, is there anybody that can speak for Mr. Ma? Like,
it's crazy.
Can Twitter like send him a burner phone and then he can shoot some, is he in touch with Snowden? Is he on Signal? Is there some way that Jack Ma can reach out to this specific podcast?
Jack Ma, if you're out there, please text me a poop emoji just to let me know that you're okay.
Somebody should be talking about this. It's just like, oh, that's China or so. I don't know what's going on, but it's. I'm so glad you brought that up last week because it'll be fun to follow in the future.
Yeah, the last straw actually came for me this week, and it wasn't. You would think that the last straw was nationalization of his companies and him not mentioning anything, right? Which is crazy. That's what got me to the last straw.
Yeah.
But what was actually the last straw for me was his local bar, which he frequented, also has not seen him since October. I still haven't gotten the poop emoji. Refresh.
I got one last rant, but we'll save it for the end. So let's switch gears.
Is it going to be contentious?
I mean, yeah, I think it will be, but we'll probably both be contentious on my side. It'll just be contentious to my new arch nemesis. Her Twitter handle is RTD Boss Lady. All right. So for those who don't know, I'm based in beautiful Boulder, Colorado. 17 years ago, this community paid a ridiculous sum of money on a yearly basis to get a train to connect Boulder to Denver, right? 17 years, no progress whatsoever. And our regional transit district just got a new president who said she thinks it's never going to be viable or potentially never viable for the space. Well, so let's not talk about this specific issue. Let's just talk about government oversight in general. If someone gives you money for 17 years and you don't deliver what you promised to deliver, how about a refund, man? Like, what's going on here? How can you just take someone's hey, Doogles, I'm gonna start giving you money for a beautiful piece of art that you're gonna deliver in the next decade, right? And then 3 decades go by, you don't give me anything. Hook me up.
The first thought that actually came to mind, and we'll actually get back to government, is you've been giving money to value stocks for 17 years, and they haven't delivered what you wanted. So,
15% a year, homie. Don't even act like I'm not printing money over here.
I'm looking at row 174. I don't see your name on there. No, I do think that that's I don't know. Government's messed up, I think, in these kinds of ways. Educate me a little bit here, because I can see giving money in 2 ways. One way would be giving money by your buying municipal bonds, and maybe there's a coupon, right, at which you're being paid. And so therefore you're lending money to the government. If the government never created that thing but still pays you the coupon, then as an investor, yeah, sure. Right. The other way, if you're paying the government via taxes specifically for something like that and they're not delivering, then sure. But is there money that has been set aside by the citizenry, including you, but the angry citizenry, including you, that's not used for it? Or is it like an implicit giving of money that you're complaining about?
So I mean, this isn't like I financed debt and knew there were some risk. Like, this is not really an investing thing. This is a straight up fairly traditional. We're taking a percent of tax revenues to provide enhanced services. And I think how it was pitched back in the early 2000s was something along the lines of, right now you pay 0.05%, you're going to pay 0.1% or something like that. And these are all the things we're going to deliver with that additional bump. You could potentially say, you know what, we were never able to deliver what we promised, but let's roll back to the previous tax rate because you're not getting the benefit that you've been paying for. That's not happening. And yeah, I know government is slippery here, but it just seems like there's a lack of accountability that doesn't happen nearly as often in the private sector as it does in the public sector.
Yeah, I think that's right. What do you do about this? You just tweeted RTD lady? Angry thoughts?
I mean, yeah, right now I'm just ranting to you. That's probably all I'll do about it, to be honest. Let's just assume I'm mad as hell and I want this to change. And I want my $100 million back, right? Or my community's $100 million back. What's the legal course of action to get that?
There's none. I'm pretty sure there's none. What it makes me think about is this tweet by David Carroll, who's a professor somewhere out east. And I'm gonna read this tweet for you. It says, "What if I told you that stimulus checks are actually tax refunds and tax cuts for the rich are actually government spending?"
Okay,
I'm gonna let that sink in for a moment.
All right, I followed the first part, and then that second part tripped me up. Let's hear it again.
What if I told you that stimulus checks are actually tax refunds and tax cuts for the rich are actually government spending?
Okay, so the first piece, loud and clear. I think that's probably the appropriate way to think about it, right? I mean, would you agree with that? So basically, if I get a stimulus check, and the stimulus checks are tax-free, I believe, which is a benefit. So I follow that. Tax cuts for the rich being government spending.
So basically, what Prof. Carroll here is talking about, I believe, right, is that he's saying that there are groups of individuals in the country that are saying that they're against government spending, right? Big government's not the thing I want. I don't want government spending. But then they're for tax cuts for the wealthy. And effectively, if you don't want the government to be giving out funds, that's the same as the government just not taking those funds in the first place. I think that is what he's trying to say for that latter part. And so you basically saying that if you're saying generally, I don't want the government to have X amount of money, then my interpretation of that is I'm taking, this is not what Prof. Carroll said, but what I'm taking out of that is like, if the government's not going to have that amount of money, wouldn't you rather the government be spending money on things that stimulate the economy versus not getting that money from the uber wealthy? Are you mind blown right now?
A little bit, but that's good, right? So when it comes to government spending in general, it's amazing to me that it's not more of a consultant-like approach. And there's no one going, have you looked at the ROI of X versus Y in terms of the ability to generate future tax revenue? But yeah, you blew my mind here.
You said you had one more item, I think, in the fishbowl, and then I got a question for you.
Oh, boom. All right, here we go. Doogles, quiz for you. You currently make let's just say it's 200K, right? You make 200K, and you've been at my company for 5 years. You've had some ups and downs. I mean, I'd say your hit rate's like 85%. The executives like you, everything else, but man, have you had some massive flops? All right, I sent you in with the CEO a couple weeks back, and he came out screaming. I think you got kicked out of the office.
I was loving this career you were painting for me right up until then. I was like, I would love this career.
So like basically, yeah, 9 out of 10 times home run out of the park, but those really critical, the most important meetings and projects I've given you, you've struggled with. So here's what you're gonna do. We're gonna just take that payback. 200 seems a little lofty. We're gonna take it back to 100. I'll put a couple like incentives in there that if you really crush it, you can get back close to where you were. But yeah, I don't really see that happening. And I'm putting you in charge of this new division where it's the most important division of the company. You have 10 direct hires coming on, and you really have to build talent and engagement to take us to the next level, right? Sound cool? You good? You on board?
No.
All right. This is what happened at the University of Michigan last week. Jim Harbaugh.
Give me some detail.
Jim Harbaugh was making $8 million a year. He was I think the 4th highest paid coach in America. He's been in Michigan 5 years. And actually, Jim Harbaugh's won everywhere he's been, from San Diego State to Stanford to the 49ers to Michigan. I think he has 3 10-win seasons in the last 5 years. But he's never beaten Ohio State. He's lost more than he should to Michigan State. Like all the key rivals, he hasn't really performed. He's 1-11 against top 10 teams in his 5 years at Michigan. So despite the fact that he's winning 70% of his games, he's not really performing in the top projects and top meetings. Their solution was to cut his pay in half and tell him to go recruit the top athletes in America and go to win a national title. In your eyes, is there any way that this has a happy ending, Doogles?
No. I mean, if you're someone that has his history, reputation, etc., right? I mean, this is just a slight. Like he's not some rookie, right? That you're basically saying like you need to prove yourself. And if you prove yourself, then you can get what you want. I mean, this is it feels like if I were him, I could be in no other situation except feel slighted. And I'm sure my brother's calling me and going and laughing at me like Nelson in The Simpsons.
Oh, so that's actually what I want to dive into. I think the psychological aspect of this is the entire story. Like, I'm sure he could pay all his bills on $8 million. I'm sure he can pay all his bills on $4 million. He's not switching houses. He's not doing anything else. He has at least a decade of being paid multi-million dollars a year. If he's not like burning money in the fireplace every night, like the money doesn't matter. But the ego and the psychological hit here, I think that's so great that I can't imagine it's successful. And that's why I wanted to frame it in the business context first.
If he showed up at Michigan, he might not have accepted this, but if he showed up at Michigan and they'd said you're going to make $4 million, and if you do this awesome stuff, then we're going to pay you more. And he's like, well, I'm Jimmy H. I'm obviously going to do those awesome things. So that sounds just like it's guaranteed to me. Versus now you're telling me I don't deserve something that you once told me that I had.
Yeah. So all this stuff is just, it's like one of the major keys. You know, there's what product sells more, the jeans that are $100 that are 50% off, or the jeans that are $50. Like the jeans that are so-called worth $100 that are 50% off sell because people feel like they're getting a deal. In investing, it's losing $1 is said to be twice as painful as gaining $1, right? You open up your brokerage account, you see that you're up 1%, and it's like awesome. But then you see that you're down 1% the next day, and you like really feel it, you know? So I guess the thing that's so baffling to me is that the administration at the University of Michigan, and I'm not trying to call them out, it's a great school, right? It could be any school. They just completely miss the psychological component. They should have structured the deal so there's no pay cut, but they have funny money going on behind the scenes. So, but when he goes to work tomorrow or 2 weeks from now, and it's tough times, and he's not super happy about his job right now and the 24 nature of being a college football coach at a major program and flying all over the country, recruiting kids and whatever else. When he has that moment of doubt and he goes, and you know what? I get paid half as much as I used to. Like that doubt is going to affect his performance. There's no doubt about it.
It's this is one of those situations, like in the business context, right? Where I think someone has to ask the question of, do you want this person to be working for you or not? Because if you're going to deflate someone psychologically so much that way, then I think you've made the decision that you don't want them there, or maybe at least you don't care if they're not there.
Yep. And I've seen companies manage out performers that are above average for one reason or another and keep less capable employees. And that's always baffled me in a way. But what would be more baffling than that is to go to that same above average employee and tell them that you're going to cut their pay in half, but you're super excited about the next 5 years together. That makes no sense.
I just thought about like so many circumstances in which like that broadly, like that generalization, like would not make any sense. Like, can you imagine doing that with like any relationship that you have, a friendship, you know?
Wait, what's the friendship example? It's like we see each other every Tuesday night for dinner and we go catch a couple of sports events together. And then I don't even know how to be that insulting. Like, I can't. Oh, we normally split dinner. Now you have to pay for me and I can only see you once a month.
Yeah, but I'm excited about the next phase of our friendship. It also makes me think like if you had a municipality, or if you had a city that basically said, can you pay me twice as much, but I'm not going to actually deliver what you want, but I'm excited for you to live here for the next 15 years.
Wait. Is this coming full circle? It's a baffling thing. And I really, again, I didn't see the mainstream media. I saw Ohio State's Twitter account, like literally laughing at it. They applauded the new contract, which tells you all you need to know. But where is like the PTI guys being like, just the human nature aspect of this means there's no chance that this is going to work?
You're ignoring psychology. It's ridiculous. So I got a question for you. You still have some time?
Yeah,
a little time. Question for you. What are your feelings on 529?
Okay, that's a little too broad. College savings is important. Let's start there.
Okay, so let's all agree college savings is important, right? 529 plans are one way that you can get a tax advantaged account toward college savings.
Yes.
Here's the thing I did. right? And this is I got a kiddo, 7 years old at this point. Here's the thing I did a few years ago is I basically took a spreadsheet, which of course, so that's where I start with everything. Took a spreadsheet and laid out like 2014, 2015, whenever I did this, and extrapolated that out 15 years to when college would start. Then I looked at the average price of college.
Yep.
The most expensive college, like the cheaper side of college, put those into 3 rows, then increased those costs by what like the average rate of college increases are right now, which is over the rate of inflation, right? Yep. It's like 3 to 5%. It's something crazy.
Yep.
Looked at that final number, and I was just like, what's the point? That was my first thought. Then I said, okay, there is a point. College savings is important. Skippy once told me college savings are important. So there's a point. So let me figure this out. So then the next step that I took is I was like, I'm looking at 529s. When you're telling me that I need to put I need to put money into this account where there's a limited set of funds that I can invest in, right? Similar to like 401ks, how they do that.
Yep.
And you want me to get a rate of return, tax included or not, a rate of return that can equal that thing at the end? Or should I just invest this on my own for the next 15 years? Right. That was the question that I
missing the tax advantages.
Is it worth the tax advantage to put the money into the 529?
So there's other options here. There's a Coverdell education savings account that's a little more flexible in spending. So I have a 529 and a Coverdell ESA. The Coverdell has some advantages for sure because you can pick individual stocks if you're a superstar like Doogles.
Doogles.
529 has some limits. 529's easy, set it, forget it. You pick aggressive, moderate, whatever, and you roll with it. Now, historically, and again, 99% of the people, 529 is probably the way to go. But what's so interesting about the environment we're in with valuations is a 60-40 stock bond portfolio. So 60% bonds, 60% stocks, 40% bonds, kind of a baseline metric, right? Historically has performed really well, less volatility, less risk, with comparable returns, right? But right now, U.S. stocks are so crazy valued and U.S. bonds are so crazy valued that the future expectations of a 60-40 blended portfolio, which is the reason I'm saying this is that's what a lot of your 529 investments would look like. It'd be some flavor of that. The return expectations are crazy. I can get this for the next episode, but it might be like 3% a year for the next decade because of where valuations sit.
Yeah, something like that, I think is right. Yeah.
So that's not going to get you where it is. I think most importantly, the exercise you did, I can't tell you how many people come to me with this and they go, that number at the end, like, do you remember the ballpark of your numbers? I mean, are we talking?
No, I can pull it up, but no, but it was ridiculous, like $300,000 a year or like something crazy.
Yep. We can tie some loose ends, but this is a case where, college is not a fate-defying business model, and you're already seeing that with the coronavirus stuff. And like the reason your above-average state schools are having kids show up in person is because they have a really hard time justifying the price tag if it's not. So my approach is drastically different, and I'll be curious for your thoughts. It's not about trying to find that number at the end and then finding a way to get there. It's trying to figure out where you sit financially and kind of what your peers can do. Because in 11 years, when your son is ready for college, who's he going to college with? He's going to college with your peer group's children, right? And in my peer group, I know very few people that are saving 5% of their annual income for education savings. That's what I'm doing, right? My sons are probably going to have above average amount of funds available to finance their.
What does that do? It sounds like you're just gloating.
No, sorry, I'm not trying to gloat at all. So it's coming across the wrong way. But you just think about supply and demand, right? Like, point is,
are you basically saying if
there's
not enough people can afford the higher price of college, then the price of college will naturally come down?
price comes down, right? So if there's an asset that I know I need in the future that I can't figure out the price of, I just want to be well prepared. I just want to have funds that I think not even above average. It's unfair to say. I want to have the average amount of funds available to buy that asset where the future price tag is unknown, because they're going to have to meet me where I am, right?
Yeah, it's an interesting look. Like that's believing that there's some economic equilibrium or economic efficiency that exists in the higher education market.
You know how I know there will be? Because political candidates for the last 10 years have run on forgiving education debt and everything else. And you know why they have to run on that? Because it's clear that for a lot of degrees at a lot of schools, the amount it costs, there's not a good return on that investment. So there's already a disconnect between price and value there. And it's going to eventually get fixed. And it will get fixed much quicker if debt is forgiven, because either we sign up with this policy that says debt will always be forgiven as it relates to education, which speaks to the disconnect between price and value, or people will say, I mean, people are already saying, this generation, that it's not worth taking out as much debt as they were previously. I want your thoughts on, you have to buy something a decade plus out and there's no good way to estimate the price. I want your thoughts on how you approach that.
The way that I approach that is different than the way that you approached it. It's like what you were saying is I want at least the average amount, right? That's what you're aiming for?
I mean, thereabouts. I want to be in the ballpark.
I want to conquer the top, like be fully prepared for what it might cost.
Yeah, I guess the thing is, I don't feel like if I don't feel like there's a realistic way to estimate, say, the average cost, it's even harder to estimate the top cost, like, so you can just say $300K a year, but I think that's ridiculous. I mean, and I think saving towards that end would make sacrifices with home buying and retirement savings and all these other things that would be short-sighted.
Say more about the home buying part of it.
I'll use rough numbers here.
You can choose a different asset if you want. Home buying was just what you said, so it doesn't.
No, I just think the rest of your family's costs, right? If I think college is going to cost $1.2 million, I'd have to run the math, but gosh, I might be saving like 15% of my salary for future college for one kid. Well, I have two kids, so I'm supposed to take 30% of my salary and put away for college. That is what I spend on my mortgage. It's probably more than that. And then I'm supposed to take another 15% and save it for retirement. Like, pretty soon, I'm living on pennies.
Or you find other ways to pay for it.
Such as steroids?
You say, this has to... Man, non sequitur.
I mean,
like you could say, okay, well, scholarships have to be like a thing that has to exist here.
Okay, but the reason scholarships are so prevalent is because price is already disconnected from value.
No, I wouldn't say that. If you're charging someone for something, right, you want to look at what are all of the sources of funds that individual might be able to have in order to price your item, right? It's the way that if I think about doing enterprise deals, for example, in business, right, and you're selling your product to the enterprise, you might be like, look, I think they're going to be able to take some of this from like IT's budget, a little bit of this from marketing's budget, a little bit from this, so we can probably charge X, right? And so in thinking about the price here, I think that they have to say, what is someone going to be able to get from the government, right? Pell Grants. What are you going to be able to get from scholarships?
You lost me at your business analogy and comparing that to private education. I mean, like, a business is making an investment whether they grab money from multiple budgets or not, because they think there's a solid ROI on that investment. I'm not studying like English literature at some hoity-toity Northeast school where I'll never use that degree and I just hope to land on Wall Street. Like, it's two different things. We need to have this debate again, I think.
All right, I'm gonna come with the fury.
You're gonna come with some facts, and I'm not gonna do any research, and it's gonna be really interesting.